Alright, if you're new to trading or just tired of being confused by the noise, this is where you start. Today, we're going to break down everything from candles, market structure, imbalances, and how smart traders actually approach the chart. No hype, no guessing, just logic. Let's get into it. Every candle in the chart tells a story. It shows us four main things: the open, the high, the low, and the close. When a candle closes higher than it's opened, it's green, bullish. Lower, it's red, bearish. The thick part of the candle is the body. The thin lines on top and bottom are the wicks. They show you how far price moved but didn't stick. This is how price speaks, and you need to be fluent. Now, let's zoom out. Candles don't matter on their own. What matters is how they move together. Price moves in waves. If a price makes higher highs and higher lows, it's in an uptrend. And then lower highs and lower lows, that's a downtrend. This wave is called structure. And this is how we understand the flow of the market. So you don't need to just look at candles, you need to look how they all act together and how they move. So what makes price move like this? Buyers and sellers. That's the surface answer. But underneath that, it's simply liquidity. Big players, smart money, they don't chase the price. They hunt areas where retail traders get trapped. It's a scummy move. And that's why you'll see a breakout and then a sudden reversal. It's not random, it's planned. This brings us to my favorite concept and a key concept: fair value gaps, or FVGs. When price moves aggressively, sometimes it skips levels, creating a small gap between candles. Think of this like a little air pocket. Price often returns to fill these gaps, and that's where smart entries can happen. Fair value gaps are usually made by hedge funds, institutions, and just bulls. Let's say that we're in a downtrend. Price forms a lower high and then drops to a new low. Then suddenly, a big green candle spikes upward, but it leaves behind an FVG. We mark it and then we wait. Once price comes back into that zone we marked and we see a rejection, that's a potential short entry. This is reactive trading. We're not predicting, we're reading what's happening and reacting to it. Now real quick, this matters more than anything. Most traders lose out not because of bad strategy, but because of bad habits. This is a fact that is not talked about a lot and is usually just swept under the rug. It's risk and psychology. They overtrade, they chase, and then they size too big. The edge isn't just the chart, it's your patience. Low risk, smart setups, and discipline over absolutely anything. You're not gonna make $1 million in a day. Alright, let's walk through everything like we're live trading. You can see right here that we're in a downtrend. Price breaks structure to the downside. Candle 1 spikes up, huge wick into the previous highs. Then, candle 2 forms after, but it fails to close higher. And what that leaves behind is a small fair value gap. We mark the gap. Price comes back, tap, and then a rejection. Boom. We enter the short, and then we ride it back down into the lows. We smash take profit. Now, obviously, this is just the beginning, but it's a real foundation that you can base yourselves on. If you want to learn how to actually read price, understand structure, and stop guessing, we break this down daily in our Discord. Live examples, chart setups, and step-by-step learning. And if this helped, and you can check out my previous video, going deeper into this exact method, go ahead and tap in at discord.gg/shadur if you want to start applying yourself. Let's go ahead and level you up.